Hey everyone, welcome to the War Room. And I'm Ryan Snell with Top Producer Investment Capital. And I just wanted to take some time to go over, what we've been going on this week. But more importantly, I want to share with you guys what the process is like whenever we underwrite a deal live. So I can show you whenever I'm evaluating a property, whether it's a single family house, multifamily property, triple net lease, all those things. We kind of do the same process where we look at comparable properties, evaluate the financials for the property over the past year, and just kind of see where we think we can make it perform, and then what we think the value of the property is, as well as where it would be a good deal. So just wanted to give you guys a chance to see how we do this, peel a little bit behind the curtain, and show you what it's like. So I'll go in here and let's see if I can figure out how to share my screen. And I mean, this isn't really scripted or prompted. I basically picked one of the properties that we own, the one in Storey Lane in Dallas. It's a 12-unit property built in 1980, a bunch of 2-bedroom, 2-bath units. And I'm just going to underwrite that one. The reason why I'm doing my own property is because whenever you evaluate commercial properties, you got to sign a non-disclosure agreement. So I can't share any financials of all the other deals that we evaluate. But if you want to evaluate your own, they're on LoopNet, or you can contact your commercial broker, sign your own non-disclosure agreement, and then they'll let you review their own financials. But since I own this one, I'm allowing you guys to take a look at our financials behind the book. 2930 Storey Lane in Dallas, Texas. So the first thing I do, which first of all, our photo should be here. That's bad on us. So the first thing I'll do is I'll just look at a property and see like, well, where is it? So this is in Dallas. If you kind of go up here, I mean, the more that you do this, the more that you learn about the good and the bad parts of town. But, over here, we're next to Dallas Love Field Airport. But what we're also next to is, there's like Harry Hines Boulevard, which is like a lot of strip clubs up and down here. Now, I didn't really know that before we bought the building. I mean, before we actually bought it, I did drive it and I did check it out and I was okay with it. But from this Google view, at least on the initial onset, I didn't really know about it. But anyways, if you kind of zoom in, you can see there's other apartments nearby. There's a few other fast food chains. There's stuff down here. And then, honestly, if you drive not too far, I want to say, if you get a little out, you can go to kind of this area or like Las Colinas. Las Colinas over here. It's not too far. And this area starts getting really good. You got a country club, you've got, malls. So it's really just our area. So the next thing I'll do is I'll get on Google Street View and I'll say, let's take a look at the building. So I know that this is actually old. This is what it was like before we bought it. I'll show you guys photos of what it looks like now, but this is what the property used to look like before we bought it. This photo was taken, you can go down here, May of 2022. And then we bought this in November, and that's when we started doing the upgrades. So they've actually improved this street quite a bit as well. And yeah, I'll show you, we've done a lot of upgrades. So then I would look at the rest of the photos. Let's go through and see. We installed this sign on the outside of the property to make it, branded a little bit. We repaved the parking lot. That sign's at night. We painted this mural along the inside of the building. So that's kind of nice. We painted all the interior of it. Kind of see it's like a mural of Dallas itself. Let's see, those are some of my notes. Okay, all right. And then here's what the interiors of the units look like. Come see, we redid all of this. New floors, new paint, new light fixtures, new ceiling fans. Pretty spacious. These are 1,200 square foot. I didn't say that here, but like when I show you the rest of it, you'll kind of see. This is the best photo, I think, to really give it. We did this as like a resurface countertop. It was like $100 to get this paint and then just paint this on, but it looks like a hard surface there. So I'll kind of look and you'll say, okay, that's basically what I'm looking for. Is has this been remodeled and upgraded or not? So because this has been remodeled and upgraded, nice looking bathroom, nice looking laundry. This comes with washer dryers. That's kind of a nice amenity too. So super nice looking property on the inside there. I don't say so myself. And then, I don't know. I don't have any photos of the exterior, but let's go on Zillow. And then I'll get the data from Zillow and we'll look at the square footage and, everything else about the property. So, well, that one says it's off market, but let's find some of the on market ones. Okay. $1,245 a month is their market rent. 2-bed, 2-bath, 1,200 square feet. available for rent. Here's all the data. Here's all those photos that we just saw. Okay, and then here's the new fence that we built. I mean, it looks okay from that angle. Should look a little bit better from the outside. There we go. We got a now leasing sign. So it's a little more safe. It feels a little more private and secure. Definitely could use better photos of it though. I'm going out there and I'll get a better photo of some of that. But anyways, market rent, they're asking $12.45 a month. Okay, so now what we're going to do is I'm going to pull up our handy dandy underwriting template. So I use Synthesis, which is something that you can buy online. And it's about $100 if you want to buy this underwriting template. I'll put a link, on Facebook or LinkedIn or wherever you guys are watching this, if you guys want a copy of this. Okay. So let me go ahead and open this up here. This is our little Synthesis template. So we're going to say the name. This is Legends. The address is 2930 Storey Lane. This is a 1980 property. I just happen to know that, but if you didn't know that, you could go, I believe on the Zillow, it should have it. If we click on here, this one's been listed for 18 days. Oh, it says 50% off your first month's rent. We're doing pretty good specials, I guess. Let's see. Yeah, this doesn't say it here, but usually apartments.com will say the year built. And it's just good. It'll give you a little bit of context. So 1984. Oh, shoot. I thought it was 1980 this whole time. Okay. So put 1984 into their unit count. This is 12. Apartments.com tells you that 12 units, 3 stories. Okay. So next, we're going to say, what's the asking price from the seller? I'm going to say, I recently had a broker tell me this is worth 1.8 million. So I'm going to say that's my asking price, 1.8 million. There we go. Now, if someone was going to buy this, they would probably put, let's say 25% down, although honestly, it's like 30% down most of the time. Probably a 7.5% rate. You can probably get 12% months of interest-only payments on that. So this would be a Freddie Mac small balance loan because the loan amount would be about 1.2 million. So Freddie Mac small balance, they can do loans over $1 million up to about 5 or 6 million. And they're good, conventional 30-year fixed loans, typically a small amount of interest only. And they're just kind of good for these smaller multifamily deals. They do not do any loan to cost. So if you want to do renovations, they may, I don't ever think it's worth it. They get so expensive when they do it. So these are kind of typical loan terms that I put in all of our deals now. If we're doing a stabilized deal, if we're doing a construction loan or a bridge loan, I would go in here and do bridge debt. And the terms for those are about, 9 or 10% as the interest rate, but they'll do anywhere between 75% loan to cost, maybe 70% loan to cost. So 20, 25 or 30% down with 70 to 80% of the renovations included. For this one, let's say I was underwriting it and we want to do, typically we do like an 80-20 split. So that means that limited partners, any investors that come along with us, get 80% of the profits. General partners get 20% of the profits here. And then I think Dallas will probably trade at a 6% cap rate. This is the final sale price is a cap rate of 6% and on the refinance at 6%. So I know I'm going kind of fast, but we're going to record all of this and put it up on YouTube. So if you guys want to go back and watch this later, you certainly can. This is more just kind of high level stuff. So you get an idea of how these things work. So, okay. And then on these deals, typically as syndicators, we charge a 2% acquisition fee and a 2% asset management fee. So 2% of the purchase price, meaning 2% of 1.8 million is 36,000. That's paid to us as syndicators whenever we close a deal. And that's paid for the work we did finding the deal, underwriting it, analyzing it, inspections, due diligence, earnest money, contract negotiation, years of relationship building, whatever you want to add to throw in there. But that's kind of our cost to like get the deal closed. Asset management is 2% of the revenue of the property throughout the time we manage it. so that we get paid a little bit of fee for, working on the buildings. Okay. Next, what we're going to do is we're going to go to our trailing 12 documents. Now, I've customized this spreadsheet. Most spreadsheets don't allow this, but what I'm going to do is I'm going to go over here and know that, let's say, whenever you would get something like this, the broker would give you an income statement or a trailing 12 document. I have that pulled up here. So it's our property, and here's all the income and expenses and net operating income that we earned last year. Now, some of the things are not on here, like this came from our management company. So like our mortgage payment is not on here. Our insurance payment and our tax payment is not on here because our property management did not pay that. I paid that directly from our ownership bank account. Most of the time, if it's a big enough property or the management company is paying those fees on the owner's behalf, they will be on these spreadsheets. I happen to know those numbers, so I'll just put them in the spreadsheet and tell you guys where they are. But basically what we'd do is we'd copy this whole thing, and then we would paste it into our underwriting template. So we're going to go here, paste. Okay, so now you can kind of see I got this little bar chart over here, and you can see when expenses happen. Right now it totals up at the end. So, this is all the total. So of course this is going to be the biggest number. I don't pay attention to that too much. So the months we've got here is January through November. So they didn't give us a full 12 months of financials. And the reason for that is because we bought the property in November of last year. So really this is our first calendar year. We didn't really, have financials, or the financials we had in November or December were, messed up. So I couldn't, our software didn't let me pull them until this calendar year. So since it's November 1st today, we haven't done anything in November. I'll just delete this. And then this total, these should be, well, the total column is kind of messed up because it included November in there, even though it's just one day. So I'm just going to delete this totals tab, and we're going to make a new totals tab. So we're going to hide all of this. And then we're going to go in here. And this is my formula. Basically, what I'm going to do is just say this is the sum of all of the months that we have so far. Close that off. And then we're going to say this is the total of all of these all the way down so that it pastes these all the way across. And now I'm going to say we only have 10 months that we're calculating. So we're going to update that. And this says the total so far, and then the total as if it were 12 months. So this is if we owned it the last 10 months, these are the totals. And this is if we expanded it to, hey, what are the likely next 2 months going to look like? If we averaged out instead of 10 months, we said same monthly average, just, 2 more months. So you get 12 months of totals. So we're going to go ahead and hide all of this. So if you want to see kind of month by month where the breakdowns are, this is where we can do it. I know a lot of syndicators like to dig into the details and certainly on properties, you should dig into the details, but for, the purposes of this call, we're going to go at a high level. So we're just going to hide all these other items, and we're going to itemize what all of these things are. So this is late fee income. I go ahead and say that this was a late fee. So I have these categories that I've put on these. It helps me code what income is what, because everyone labels things differently, but then I have my codes on here for what things are. So kind of take this for a grain of salt. It's just my way of inputting the data into the spreadsheet pretty quickly. Lease buyout fee is basically if somebody moved out early, so they paid us $279. I'm going to call that security deposit, which is basically anytime a tenant pays us money for an action that they took that we could have taken out of their security deposit or something. It's kind of a catch-all term. Again, lease buyout fees can pertain to a lot, but for this worksheet, that's what we'll call it. Pet rent income, I'm going to call it pet R rent. That's GR for gross rent. Utility, this is RUBS, resident utility bill back system. It's a form of other income. People split their water bills. They pay us back the water. Okay, cleaning and maintenance as an expense. This is R&M for repair and maintenance. A leasing fee. This is a management fee. Management fees other. There we go. Renewal fees. That's a management fee. We've got repairs, that's R&M. We've got supplies, that is R&M. Utilities. So this, they didn't break it out into electric, water, gas. I like to typically break it out, but when they don't break it out, we can call that electricity. Utilities, trash. This seems super low. I feel like I've paid a lot more in trash than this. So I don't know, maybe some of these other utilities are really trash and they just categorize only one of them. But anyways, okay. So our total income and total expense and net operating income should line up. So I'm going to go to this actuals, and it looks like our net operating income lines up, which is good. That means all these other things did line up as well. Now I do know some of these other values, so I'll just go ahead and put them in here. Real estate taxes, I don't know off the top of my head, but I'm going to look online. So to find out your real estate taxes, you're going to go to your county appraisal district. And we're going to search for the property. So we're going to search by street address. And here it is. Here's our property. We can see that we own it. And here were the taxes we paid last year, $19,505.64. Maybe that's our tax bill this year. I wonder what year that is. It said, oh, 2024. Okay, so that's our current upcoming tax bill, which is great. We already know what it is. Okay, so tax bill is that. We can even go in here and say that we know the tax bill is going to be this. Okay. Insurance, I know this recently was $18,000. And this is pretty high, but it's because we have large units. Contract services, we didn't use anything outside of what was on the trailing 12 documents. We didn't have any evictions. Our management fee was in there. 10.5% was our net management fee, but we did a lot of leasing. General admin, payroll, advertising, we didn't do any of that. So we actually did pretty good. Okay. All right. So now we're going to add in the units. So to do this, we are going to go to our rent roll. Now, typically, oh, sorry, this is our income spreadsheet. Here is our rent roll. So this shows all the income and from each unit and if it's occupied or vacant. So you can kind of see all the units that we've got here. There's 12, 101, all the way up to 304. Whether they're occupied, we have one vacant unit. When the lease starts, when it ends, 2 bed, 2 bath. You know, it doesn't say the square footage on here, but we know from Zillow they're all 1,200 square foot. Or at least if we didn't feel 100% about that, we would ask the broker to confirm. So we go down here, 2 bed, 2 bath. There's 12 of these, 1,200 square feet each. Current rent. So that is where we are going to look over here, and we're going to kind of just take the average of the current rent. So we're going to say the rent right now. Now, usually there's market rent and current rent. This rent roll doesn't have market rent. So we're just going to average all of these out. And our Excel spreadsheet will tell us the average rent is $1,379. That's what we're currently getting. Now our target rent, I know, is $1,450. Now the way that I would find this out is I would run comparables and, you know, kind of figure out where the purchase price is. I'll do that, you know, real quick. It's a little higher than the scope of this video, but basically, you know, on a larger scale with more precision, you know, what you would do is you'd go for rent. We're looking at the 2 bed, 2 baths in the area, really 1.5 in the area. We're looking for not houses, not townhomes. And then we would say, okay, these guys have 5 units up here. Their 2 bed, 900 square foot is $1,430, and they kind of look like this. So I'd say it's about the quality of ours. I think ours is a little better. We've got nicer fixtures, nicer cabinets. Well, our cabinets were just painted recently. They've got more community amenities. They've got this slide. They're in a slightly better area, I happen to know. You know, then we'd kind of zoom out a little bit, see this guy's 1,500 for 1,200 and 1,100 square feet. So that's kind of the range where we want to be. So we're good there. Okay. And then the other thing, I have our formula auto fill in some of our other income that we should get based on these units. So RUBS, we typically will get 75% of the utilities billed back to us. Application fees, we should expect about $1,200 in fees there. Late fees from people paying late. Security deposit, that's if, you know, people trash the unit and I have to do repairs, we can keep some of their security deposit. Pet rents, pet deposits, and pest if we want to charge pet fees. We are not charging any pest fees. Late fees, I think this is pretty high. We'll put this as like 200. Application fees, I know we're not charging any on this property. And then RUBS, that is also kind of high. So, but this will auto-calculate when I change the actual expenses. All right, so now I'm going to go to our pro forma, and we're going to say, how much is this property going to improve over the course of the next 5 years? I know this is a ton of numbers, a ton of data. Try not to look at any of these numbers. This is just future year calculations. The only two that we're looking at are these columns right here. This is the actual column for how we did the previous 12 months or how the previous owner did. Here is what those items are on the actuals. And then here's how we think we're going to do in our first year. So the first year, I don't think we're going to raise the rent any at all. We're basically going to try to get it up to this $1,450 number by the end of the second year. And we're not doing any renovations or upgrades because the property is already finished. So we're going to get it up to, let's say that $1,550 number. So we'll say 5% there. And then I think Dallas is going to increase at about 3% inflation rent growth per year. Who knows what's actually going to happen, but I do think over the long term, 3% rent growth is a good conservative number for Dallas. I think we'll probably have 7% vacancy, 2% concessions, lost lease problems there. We already know the property taxes here, so I just copy and pasted that earlier. The insurance right now is $18,000, and that's going to stay there because I talked to our insurance guy, and that's the quote that we just paid to renew. So that's the insurance number. Usually a good rule of thumb for this, though, is about, right now insurance has gotten so expensive. So I'd say about $850 a unit if you're buying stuff that's older than, 2010. The larger the square footage, like basically if the average square foot is 800 square feet, you'll probably pay $850 a month. But if you get up to it's about $1 per square foot now. So, if you've got bigger square foot units, you probably pay $1,200 per unit per year, $100 per month per unit. And then, if you're in, Houston or by the coast, or the property's had a lot of claims, you'll be higher. We've had a lot of claims. That's why our number is higher than that. But I've seen some by the coast get to like $2,000 per unit per year, which can be a lot. Contract services, we didn't have any last year. This is like the reason we didn't have any is because one of the residents that stays there gets a discount on rent in exchange for doing, lawn care and services around the area. So we will continue to keep that trend. Put this at 0. Trash removal. It really should be $2,000 a year. I don't know why it's only $300, but this is a good rule of thumb. It's about $175 per unit per year. Electricity. I know that this is pretty high. And I know the reason is because we were renovating a lot of the units. And so a lot of the water and electric was on more often because of the work that we were doing during the renovations. Realistically, this is pretty high. So like, just because I know this property, I would go with my rule of thumb. And that typically is like $200 per unit for electricity. And then for water, I usually do about $800 per unit and times 12 units. Okay. Management fee, let's keep it at that 10% because we paid them that much last year. No, it'll realistically be around this 8% number because our actual management fee agreement is 6.5% for property management services. Plus we pay a leasing fee of like $150 every time a unit is leased and $150 every time their lease is renewed. So that ends up being about 8%, which is not a bad deal for the work that they're doing on the property. Repairs and maintenance, yeah, right about that $7,000 number per year. Seems about right. General and admin, this is like any software that I have or anything else, but since I'm not really running a lot of general administrative stuff, we could honestly put this at 0. Advertising, if I wanted some in there, we're not really doing any advertising, or at least the stuff we have on Zillow is free. So we're going to keep it there. And then we also do not have any payroll because we have a third-party manager. So realistically, we'll put this up to 10. Repairs and maintenance, let's put this back up at probably $750 because we're not including any of these other fees down here. I'm just bumping this up to be conservative. And then, yeah, on these contract services, let's just put like $2,000 in case we need a plumber to come out a couple times a year. And then we need $3,000 of reserves. $250 a unit a year is a good kind of rule of thumb for in case the roof falls apart later, we need a plumbing repair or something. $1,500 for accounting. Okay, so if we total all this up, we're basically saying this last year we had $113,000 of revenue. This coming year, we should have $186,000 of revenue. So this is a huge jump for a property where the average rent is not increasing. So it kind of begs the question, well, like, why are we going to have such a big jump? And the way that we figure that out is we go to this trailing 12 document and we say, okay, because it was such a big jump, let's go find our gross rent, which is this rent income. And you'll notice that the trend is going up over time. So we had 6,000, 7,000, 8,000, 9,000. We had people move out. We dropped down to 8,000. Then we had people move in back to 9,000, 10, 11, 10. This is because somebody was late and they paid us a lot of money to get caught back up on their late fees. 11, 10, 11, or this is almost 12. And then we'll have even more as we have that last unit filled. So we had kind of a slow summer, but that's why it's going to have such an improvement, is because if you think from a big perspective, a high level perspective, if we're trying to rent these out on average at $1,350 per month times 12 units, that's $16,000 a month. And we're only collecting $12,000 per month right now. But that's because we had somebody just move in November and that's not shown up here yet. So we've got another $1,350. We have one vacant unit. Once that gets filled, that'll be another $1,350. Plus we had somebody who had not paid in this month. So anyways, we'll get up to $1,600 in general. And then if you multiply $16,000 per month of revenue times 12 months in a year, we're going to have $194,000. Now, obviously we have to take vacancy out of that, but you can see, even though we've had, the total was $130,000 of income this year, realistically, now that we're full and finished with renovations, we should have $194,000 next year. Okay. So let's go back to, so after we take out 7% vacancy, meaning, we'll probably have like units vacant for like 2 weeks a year. About half the units will not renew and move out. That's kind of standard. Take us two weeks to kind of get them refreshed and get somebody else moved in for each one of those units. So we're at $186,000 of total income. Here's all the expenses. Total expenses are $81,000. So total expenses is our net operating income is $100,000. Now our debt service, which is going to be interest only on this loan, is $94,000. Now that's if somebody, if we go back over our loan information, puts 30% down and their rate is 7%. So it's kind of a lot. Like basically your whole mortgage payment is eaten up by interest. To put that in context, the next year we go to principal payments because we did, interest only this first year. So when we add $12,000 of principal payments, we're looking at, total debt service of $106,000. And so we have a whopping $7,000 that we would be able to distribute to our investors. And then out of that, we take an asset management fee as the new owner of $4,000. So it's only like $2,000 we're able to distribute to any investors after we take out the asset management fee. And that's per year. This is year one, $2,000. So like per month, it's like $100, $150 for all of the investors. So somebody invested, well, we haven't gone into the renovations. I'm just going to say we're doing 0 renovations on this because, we'll do some reserves. These are the reserve tab up here. So we're going to keep an operating reserve and a debt reserve. Operating reserve is, between 2 and 3 months of expenses. Debt reserve is between 2 and 3 months of mortgage payments. So we've got about $30,000 of reserves so that we won't miss any payments or expenses, even if the property was 100% vacant for a couple months. So anyways, I'm just going to delete all of these other items because we're not doing any other renovations. We're going to buy this property as is. Okay. So if we go back here, we say the total amount that someone has to bring to closing for 30% down. Here's the equity stack. Down payment is $540,000. Acquisition fee paid to the syndicator for finding the deal is $36,000. The closing cost to buy the deal is $50,000 and then $30,000 of reserve. So we would have to raise $660,000 to buy this property. So, and then when we go to our cash flow, if you're an investor and you come in and you say, okay, well, I contributed some or all of this $660,000 and my total take home is $2,000 here, 6,000 here, 9,000 here. It gets to be more over time, but that's not very much. If you're looking as an investor, let's say you put in $100,000 as an investor, and you're going to say, well, how much am I making? So this first year for my $100,000, I'm making a 0.2% rate of return, $200, 0.3, 0.7, 1. So this is kind of what, the average person, if they were going to buy this deal, this is realistically like what they're looking at least at the market value. Someone told me it was worth 1.8 million. I think it will be once rates go back down. I don't know, maybe somebody would even pay that right now for this property, 150,000 a unit, because there are nice looking units, but when we look at this on the whole, like this is basically saying if we own this thing for 5 years and we sell it at a 6% cap rate, then it should be worth $2.1 million in 5 years. And the reason it's worth more in the future is because it's going up in value 3% per year. We put that 3% rent growth inflation number up here, 3%, starting year 3, 5% to catch us up to pro forma by the second year. So anyways, that means we're going to have this be valued at $180,000 a unit in 5 years. But 5 years is a long time. If you think about how much property values went up between, 2012 to 2017, for instance, that's 5 years. In Texas, in Dallas, you definitely saw properties, go up more than like $150,000 house back in 2012 was probably worth at least $180,000 in 2017, even more exaggerated if you went from 2017 up to 2022 when, prices were kind of a lot higher at their peak. The next 5 years, who kind of knows what's going to go on with the market. But personally, my belief is that I don't think the rates can stay this high forever or else the economy is going to break and crash. So they'll probably, come back down to the 5% range at some point in the next, 2-3 years, certainly by 5 years from now. So anyways, if you were to buy this deal, and you were able to sell it for $2.1 million in 5 years, which I think is realistic at a 6% cap rate. Keep in mind this says we're buying at a 2% cap rate, but that's because we improved the property so much all year. So it's hard to really get the value of how profitable it was because the property was vacant most of the year, or like mostly vacant most of the year. And once it's up and running, then it'll be good. So if I were evaluating this property, we work with limited partners. We want our investors to make at least a 15% internal rate of return on their money. So what I would do is I would come down here and I would start lowering this purchase price that I would offer to the seller in exchange for getting this internal rate of return up to at least 15%. So let's say we offer them 1.7 million. All right, we're getting a little higher, 8% internal rate of return. Let's say we do 1.5 million. All right, now we're at like 14% and we're getting a 4% cash on cash. That's not too bad. How about 1450? All right, 1.45 million. Now we're at a 16% and a 4% rate of return. That's looking pretty good so far. So if you're an investor and you come into this deal for your $100,000, the first year you're making $3,000. Pretty much every year you make $3,000, $4,000, $4,000, $5,000. So it's not a ton, but like for doing zero work, that's better than nothing. And then, when you sell it, you'll get $85,000 of profit from the sale. So most of this is the appreciation over time. I say it's appreciation over time, but realistically, you're buying a property that's worth 2.1 million you're only buying it for 1.4. When realistically, brokers are telling me in the market they could probably get 1.8 for this right now. So if we, when we make offers to sellers, we would buy this for $350,000 less than the market's paying right now. And that $350 is just profit that'll go back to us at the end of the day, plus the appreciation factor over time. And you're diversified in commercial real estate. So this is kind of how I underwrite deals. This is a lot of numbers. I mean, realistically, what I would do at this point is I would call the listing broker and I would say, hey, is your client willing to come down to like 1.3, 1.35, depending on where they are. We can go out to the property and tour it and meet them. And, and then when we meet them in person, we can kind of negotiate. So what we would do is I'd tour the property, I'd negotiate, I would send them a letter of intent and I would say, hey, my company, Top Producer Investment Capital, intends to buy this building for $1.4 million or 1.45. There would be a negotiation. We'd write up a contract. And then we would basically just get to offer, hey, here's what's going on. So that's kind of the process. And that's why I typically feel confident in any deal that we buy is because, we're usually buying stuff that's 20% less than what a broker thinks that the average person would sell it for. Now, this one's already fixed up and finished. So I kind of know what the value is going to be there. Well, yeah, I'd say now that we're making, our mortgage payment, I want to say on this is going to be about $6,000 a month. You guys saw the other expenses there. I'll pull them back up. Our actual expenses came out to be about $73,000 for the year. So that ends up being about $6,000 per month. So we've got a $6,000 mortgage payment, a $6,000, other expense payment. So we're, let's see, our total profit is going to be on $16,000 of rent. So we'll take home about $4,000 or $5,000 per month on this property. So it's not too bad all in, considering, we bought it at a good price. So that's kind of what we're looking to do on deals that we find out there in the marketplace. And, most of the time sellers are smart. If they have a good interest rate locked in and they don't need to sell, they're going to just kind of hold on to their property and not sell them. But if they do want to sell, if they're motivated, if they are losing their money for some reason, they'll accept some lower offers and they're kind of go. So I haven't been checking the chat, but let's see what people have got going on. Matthew's got some fun things to say. He appreciates the artwork on the murals. That's really nice. Thanks so much. We find it's important to do a little bit of custom artwork on the properties. It adds that flair to the property that makes it, a little more valuable, a little more desirable, at least stand out from the other comparables, so that people can, pick our property amongst the 10 others that all look the same. At least ours has some cool artwork, or maybe it'll justify our rents being a little bit higher than the one next door. So just a little touch to help go a little extra. One of the questions is, are we checking comps on Zillow? So we check them from a lot of places. I did Zillow just as an example. So just to kind of, I can go share my screen again, but just to show. So like on Zillow, I'll usually look at, 4 or 5 properties nearby and see what they're renting for, how many square feet they are, how many bedrooms and bathrooms they are. So if I say we've got a 2-bed, 2-bath, I would try to find the closest, 5 or 6 properties that are 2-bed, 2-bath within 200 or 300 square feet. Or if there aren't any within that many square feet, I would just do $1 per square foot calculation and ramp it up. Zillow is good for that. Apartments.com is good for that. Sometimes just getting on Google Maps and looking for apartments and clicking on them is good for that. But this is all from a high level view, just to give you a rough estimate of what you think the rents could be, whether you think you could get $1,300 a month or $1,200 or $1,100 or maybe $1,500 a month. But these calculations can fluctuate quite a lot. So if you think you can make $1,500 per month per unit every month of the year, that's $200 per month times 12 units. So we're looking at $2,400 a month increase times 12 months a year. You're looking at making, what is that? An extra $20,000 to $25,000, $26,000 a year just from charging $1,500 a month instead of $13,000. So it makes a big difference on your bottom line profitability, what the exact number you think you can get to on average. So yeah, all those places are good. But then the reality is, if we're actually going to make an offer, instead of just checking Zillow, what I'll do is I'll go to each of those, nearby apartment complexes, and I'll walk in, I'll talk to the leasing agent. You can tell them, hey, I work in real estate, I'm looking to do a market survey, and they'll tell you, hey, here's what we're charging for each of our rents. Here's our vacancy. They're usually pretty open if they understand that you also work in property management. But a lot of the times I'll just try to get the customer experience, and I say, hey, I'm looking to move in the area and check out some stuff. I can't wear my normal business stuff. I have to wear just kind of like t-shirt and jeans. But if you go there looking, like you might want to rent the place, they'll kind of, you can learn why they're able to charge the rents that they are. Is there stuff that's obviously deferred maintenance or not being kept up? Or is the staff rude? Do they just have no sales skills? Or maybe when you go there, they just don't have any vacant units and their rent was a little low, but they're 100% occupied and they don't have any availability coming up. Maybe they're just having rent that's too low and you might be able to get rent that's a little higher. Or when you go there, if their rent is $1,500 a month, but you kind of find out they're 50% vacant and, they just don't have their, hands on the pulse of how their marketing and their rents should be to garner that kind of income, that's the other part of it. So that's how we do comps. I want to keep doing series on these, either interviews or underwriting tips, or just showing you guys, real estate can be pretty complicated. I mean, obviously you saw the tools and the software that we use, takes quite a bit of a learning curve to get up there to do proper analysis. And even then there's a lot of fact checking that goes in behind after we do that analysis. So, that's kind of our job, is to take the time, do all of that for investors, teach them what we're doing behind the scenes, so that even if it's a mystery box, at least they know that we've got it handled, and that we do all of our due diligence and thorough underwriting and investigating before we get on these properties. So I'll end the stream here. If you guys like the video, leave some comments below. If there's other things you guys want me to cover in these series for the War Room, feel free to make posts. I come on Wednesday nights at 6 p.m. I'm going to try to be as consistent as I can with that and give you guys some heads up. But other than that, kind of let me know what you guys want to see in the future. I've got a couple of guests lined up that have a lot more experience than I do. They're going to tell me about their history and making money in real estate, how well they've done, some of the mistakes that they've made, and anything else that they want to share stories on. So I'd encourage you guys, tune in next week, Wednesday at 6 p.m. Central Time, and we'll get some stories. All right. Thanks, y'all. Chat soon.